My name is Stephen Rothstein, and I'm thrilled that all of you are here. We have quite a distinguished group of speakers, so I'm going to be brief. Again, Stephen Rothstein, I'm the Managing Director of the Ceres Accelerator for Sustainable Capital Markets, and welcome to this discussion of the role of financial professionals in accounting for finance admissions. We are thrilled that you're all here, and even more excited to be doing this with Accounting for Sustainability, A4S. It is a distinguished organization. They're doing so many important initiatives, but we'll let them talk about it. So many of you on the call we work with on a regular basis. Some of you are new to the Ceres work. We've sent out information. We'll send out follow-up information in terms of links. So if you have questions about any of our other programs with investors or companies or policy work, let us know. We're happy to follow up later on. As I say, we have quite a distinguished group of speakers. I think you've all received in a link 2 recent reports we've done about banks. I'm not going to go through this in detail, but in 30 seconds. One we did last year that focused on transition risk and highlighted the transition risk that's north of $500 billion for some of the largest US banks based on some of the analysis that was done. And the more recent risk that highlights the physical risk that talks about that being literally $250 billion a year on an ongoing basis. There's so much happening daily with banks and financial institutions, and you're doing such important work. There is the work of the Net Zero Banking Alliance that we're working closely with, and several of you have joined, including some just very recently. Some of you have already set important 2050 or 2040 goals that are great. Many of you are working on the short-term goals, 2030, which are all in the context of how is all of this counted for, which is what we're going to talk about today. Again, if you're not familiar with our work, we'll send out contacts, including my email and Jim Scott's that you can follow up with. But just in last week, the federal government in the United States, through the Treasury Department, through the FSOC, came out with a report, but they had lots of things, but 2 key points. One is they talked about climate as an emerging risk for all financial institutions and one that you need to address. They talked about the need for scenario analysis and other things, but they also highlighted the importance of data, that we need to have more consistent data. So today's discussion could not be more timely. So with it, it is truly a pleasure to introduce Brad Sparks, the Executive Director of A4S. We love working with them. And Brad, I'll turn this over to you.
Thanks, Stephen. And you're exactly right. There's so much happening in this space right now and going into 2022 that this is definitely a timely topic. We're really thrilled to be working with Ceres again on a workshop and helping talk about the specific role of the finance teams in thinking about measuring and supporting the measurement and disclosure of financed emissions from financial institutions. So as Stephen mentioned before, A4S is focused really on working with the finance and accounting community to deliver a sustainable future. We were established by the Prince of Wales back in 2004, and we work with CFOs, finance teams, asset owners, asset managers, and others across the entire finance system to help make that transformation to embedding environmental, social, and governance issues within decision-making. All of the information we have available through case studies and practical guidance on our website, a4s.org, and I encourage you to check that out for some reference materials that may be helpful as you think about what you and your organization can be doing, again, to deliver a sustainable future through your activities as finance leaders. So a few quick housekeeping notes before we get started. One, as you may have noticed, we are recording this workshop. And 2, we want to really encourage you to ask questions through the chat feature and the Q&A feature throughout this webinar. We will have dedicated time with the panelists to ask questions, but we encourage you to submit any questions that you have through the chat feature throughout the duration of the next hour. So please do that and make sure we cover any of the specific topics that are of interest to you. As Stephen mentioned, we have a fantastic panel with us today. Just to introduce them briefly before we get into the panel discussions, we have from Citigroup, Vice President of Climate Strategy and Impact, Alicia Gorecki. From NatWest, the Head of Regulatory Assurance, Supriya Sobti. From Amalgamated Bank, newly titled Chief Sustainability Officer, Ivan Frishberg. And finally, from JP Morgan Chase, Vice President of Sustainability, Jackie Lyon. So again, a real powerhouse of leaders in the space that are willing to share their experience with you and hopefully get the questions that you have answered on this very important topic of the role of the finance team in supporting the financed emissions accounting process. So what we've got today is kind of two different sessions. First, we'll be talking on, again, that kind of overview of how to think about accounting for financed emissions in the first half. And then secondly, we'll get into some details on the specific methodologies that are being applied to do that. So let's get started and bring in both Alicia and Supriya. Alicia from Citi and Supriya from NatWest. And we'll get started with a few questions. But before we do that, I think, why don't we get a quick overview, starting with you, Alicia, of how Citigroup has gone about working towards accounting for financed emissions.
Sure. Hi, everyone, and thanks again for having me today. I'll provide a quick overview of Citi's journey in the financed emissions process. So Citi joined the Partnership for Carbon Accounting Financials, or PCAF, in August of 2020 and committed to piloting the PCAF standard and disclosing the results in the 2021 TCFD report, which we have been working hard at this year and plan to disclose the results by the end of this year. Citi also joined the Net Zero Banking Alliance in April, so we knew that our financed emissions process would be closely followed by our 2030 target setting. So a lot of our prioritization drew from both the PCAF and the NZBA frameworks. Due to this, we decided to start with the business loans and project finance asset classes for our first round of disclosure and target setting. And this year, we also focused on two priority sectors for our first rounds of calculation. These are the energy and power sectors, drawing from the NZBA priority sectors and also focusing on two of the more carbon-intensive sectors to start this process. We do plan to use the Net Zero Banking Alliance priority sectors to guide us as we choose upcoming sectors to further our disclosure in the coming years. So since these commitments, it's been a journey. The overall process has been full of lessons on data quality and availability and becoming comfortable with the approximations we have to make for the emissions estimations and things like that for these calculations. And the two main steps to start the process that we did was a data assessment in terms of what's available and what we have and what we need to source, as well as internal socialization to understand the path forward and map out the necessary steps and engage the right teams to do the calculations that are best efforts this first year. Sure, we'll talk more about this, so I'll leave it at that for now.
Great, thanks for that quick overview. And Supriya, can we do the same for NatWest?
Yeah, happy to do that. So our journey is pretty similar. So in February 2020, we announced our purpose-led strategy. And as part of that, climate is a key focus area. And we announced that we will work to halving the climate impact of our financing activity by 2030. So that effectively was the start of our journey on carbon emissions calculation and evaluation. We subsequently joined PCAF in 2020 as well, followed by signing up to the Science Based Targets Initiative. So since then, we have been working to calculating emissions. Last year, we focused on 4 sectors: mortgages, which is a big part of our loan book, agriculture, which is one of the carbon-intensive sectors, automotive, as well as oil and gas. Again, these are all high-risk sectors, and as well as mortgages, which is a big part of our book. And we published our initial outcomes in terms of financed emissions, emissions intensity, alongside the PCAF data quality score in our 2020 climate disclosure report early this year. And I completely agree with the challenges that Alicia just called out in terms of data quality, in terms of kind of the changing methodology. So while we have PCAF, we're all doing this for the first time. So that's been quite a challenge. In terms of, I suppose, how we went about it, we had set up a small group with specialists from strategy, finance, risk, franchises, as well as legal. And as the process has progressed and as we got near to our disclosures towards the end of last year, I think finance has started to take on more of a lead, and that has evolved through last year as well as this year. We're obviously working to develop our capabilities on financed emissions and across further sectors. And because we've signed up to the Science Based Targets Initiative, we're also using their priority sector list as well as the Net Zero Banking Alliance that Alicia mentioned, as we are also members of that. So there is a lot going on, and it is a journey, but it's quite a learning area, and it's progressing well.
Right, and we definitely want to get into some of those challenges on figuring out sectors, looking at data quality, and the involvement of different groups. I think a common challenge that everyone faces though is how do you even get started, and where do you go to move forward? So Supriya, back to you. I mean, could you share a little bit about that very early stage of what prompted NatWest to start to think about this, and how did you bring on board the relevant stakeholders?
Yeah, so as I mentioned, we announced our purpose-led strategy in February 2020, and that's when I suppose we laid the stake in the ground to say, okay, we need to calculate our emissions on our lending book, because we've now set our target to kind of halve that by 2030, right? So that literally was the starting point. And joining PCAF gave us a standard to work towards, because till then, I suppose methodology is probably one of the big black holes as well, right? Because that is developing. And even where there are methodologies, there are inconsistencies across the various methodologies available. In terms of how we started the process, as I mentioned, we brought together a small group to just start off, because very conscious that we won't get to perfect answers at the start. So it started off with very much with strategy, because it was linked to a forward-looking ambition, risk, because this will have an impact on how we lend, etc., finance, legal, as well as we have been quite keen to involve the business from the start, because we realize that while we can do the calculations to change the emissions and to achieve the desired results, we would need to start offering and supporting our customers' transition as well. So that was a very small group that came together in 2020 to start working on this, and it has truly expanded and spread across the organization as we have continued to develop. As well as we are looking at the results that are coming out as well, and that's guiding us further on how to build this capability as well.
Great, thanks for that. Alicia, for Citi and kind of getting started and then thinking how you even go about bringing the right groups together, could you go into a bit more detail of kind of what parts of Citi were involved? How did you move forward and start thinking about developing a response to being able to measure finance emissions?
Yeah, absolutely. I can speak to that, and I can echo a lot of Supriya's thoughts and how they went about it. I think really we brought together a small team, but where we realized we needed to refine and understand who needed to be involved was through the data assessment that we did. So understanding what we have internally and what we need to source externally, and who within the firm is best placed to help us ensure that we have the right data to do the financed emissions calculations. Especially for our first go around, we wanted to ensure that all of the necessary parties were involved, and anyone who could contribute and help us with this very intensive process was looped in early. And so while we also brought together small teams within sustainability and climate risk, as well as the business, the corporate banking teams, and the industry leads, we also socialized this internally on a broader scale very early on. So with a net zero commitment that was made, we wanted to ensure that anyone who might have anything else to contribute was engaged. And so that through this process, we narrowed in on the teams that needed to help. But I think additionally, where we really started to refine our more close working group was through the data process. And so thinking through the 3 data points that you essentially need to do this calculation was a great way to understand who needs to be engaged. And I can talk through that very, very briefly, but the 3 main parts of the financed emissions calculation are your exposure to the client divided by the client value, and then multiplied by your client emissions. And so those are the 3 data points we think through this process in. Exposure to the client is obviously sourced internally, but brought about, some other considerations that we needed to involve teams in, especially the decision about using either drawn funds, which is per the PCAF standard, or thinking through the use of committed exposure, which might better reflect the amount of capital that a financial institution is willing to fund, and therefore could be a relevant metric to use for your greenhouse gas emissions attributions as well. So even a simple data point that we, obviously have internally, such as exposure, drew in other teams that needed to discuss this decision making. Second data point is, client value, which for public companies is something we can source externally, but for private companies is the debt and equity figures that we had to involve, the relationship owners or the industry teams to better refine these figures as well. So where we were relying, on our sustainability and climate risk to do the calculations, we were bringing in the relevant parties that can help refine these data points as well. And finally, the client emissions is the third data point that we also need for this calculation. And that was, a combination of teams working to help refine this, both leveraging external data providers, but leveraging our internal data teams to help us match this external data set to our internal data set and ensure that we're doing that efficiently and weaving all of these components in together. So we're really seeing a lot of different teams coming together for the different parts of this calculation.
Great. Maybe just one follow-up to that, Alicia. And, as you think about maybe existing internal processes that were already established, was there an opportunity to leverage any of those as you set up that data collection process?
Absolutely. I mean, I think there is a lot of this data is stored internally, and we just had to figure out the right things that we needed to weave together. And so some of these processes were in place, others are fairly nascent in the firm, such as ESG data sets and greenhouse gas emissions, which we were not the only team interested in this type of data. So we could leverage the work of previous sensitivity analyses to map our clients more easily for the purposes of greenhouse gas or the financed emissions accounting. But it was an interesting exercise in the sense that obviously this type of work stream did not exist, and there was a lot of tying different pieces together to get our final product in line.
Great. Yeah, and when we think about those roles and responsibilities and structuring this, you get everyone assigned with the right task where they can best contribute. I know Supriya at NatWest, the finance team themselves helped a lot with that management information, the collection of some of the data. Can you describe in a bit more detail maybe where the finance team specifically got involved with the NatWest process?
Yeah, happy to. So as I mentioned, we started off as a part of a small group, but and as I mentioned, I think as this became more data intensive, so obviously Alicia has really eloquently laid out all the data points. I think the challenge for us has been getting client data. So in a sector like agriculture, right, we don't always have farm level data. We have good data on listed companies, but not always on unlisted companies. So there is a big portion of our client base where we have that data missing. Also on mortgages, we're using the energy performance certificates, so the EPC, as a measure for the emissions that a home generates, and that data isn't always available and expires after every 10 years. So there are a lot of gaps, and this is where there is a need for judgments and extrapolations, etc. required. And that's where I think finance really started to get involved, because we wanted to make sure we were making the right decisions. And those decisions were consistent, as you rightly said in your earlier question, with other processes we have. So we didn't want the finance emission number to look totally different and not correlate to our regulatory or financial or risk kind of lens. So any decisions we were making sure they aligned to these lenses, and that's where finance started to get involved as it got closer to reporting. Also, PCAF has a very good data point, which is the data quality score, and that allows banks and everybody else who's using the standard to be really transparent about the data quality. So where we could find data externally, we were good data quality and a good score, but where we had extrapolation, we were really honest and kind of marked ourselves down where we needed to, just because that's an area of development that we need to focus on. As we got nearer to the disclosures, We've brought the emissions disclosures and the climate reporting into the same governance process as our other financial reporting to give that a consistency and the level of review and robust challenge that we apply to our existing reporting. And again, that's where finance took the lead. And since then, I suppose I work in finance, so we've taken on the responsibility to expand the sectors in scope. As I mentioned, we calculated the emissions on 4 sectors last year, and as we're expanding that, finance is very much leading the process to make sure we have robust controls, governance, processes laid out through the process, so that this becomes a process that's repeatable and it's not a one-off exercise. Because I think that's our aim, that this becomes a data point we talk about, incorporate in our decision making, we include it in our MI, and it becomes a business as usual thing, and carbon isn't a thing that's sitting on the side that only certain people in the bank look at. So I think that's very much the intent, and that's what finance is driving, the incorporation of climate in decision making.
Great, and just a reminder for everyone, please submit any questions that you have for Citi or NatWest through the chat or Q&A feature on the webinar. Supriya, maybe just sticking with you for one more question. I was looking back at the AFRS NatWest case study that was released earlier this summer, and it's available on our website at afrs.org. And one of the things you talk about is kind of the education and training program to help people understand, how do you embed this understanding of financed emissions through the culture of NatWest. Could you describe that a little bit more about the approach you took there?
Yeah, so as I mentioned, we've tried to bring the business along the journey right from the start. And obviously, those people aren't accountants, they aren't like very technical. Their main role is to kind of work with clients, make sure, the clients are okay and we have the right kind of support and providing them the right support, etc. So as we have gone through each sector, what we have done is we have set up sessions with them to explain to them the calculation, not only the formula, but also how we are gathering the data, get their agreement on data, any extrapolation, they agree with that. We're having to make a lot of kind of assumptions on, say, for example, on commercial real estate, on the EPC for the underlying property. Does that make sense to them based on the customers we bank? So I think what we're trying to do is share the methodology as it's developing with the people who will be responsible for making decisions in terms of how they reduce emissions. So there's a lot of work we're doing with the business teams and taking them through the journey. We also have something called a climate technical forum where we bring in more kind of expert teams who look at risk, legal, the economists in the bank and other areas to get a shared view of the assumptions we are using, the scenarios we are applying for a more forward-looking view, and then obviously make sure that the business agree with the assumptions underlying the scenarios, as well as the calls we are making with regards to the calculation. So while we are focusing on the calculation, we're also focusing on taking the bank and the teams who will be involved in making this business as usual in the process so that they understand, because you can't manage what you don't understand, right? And I can report a number on a monthly basis and give it to someone, but they need to understand what it is. And we are focusing on that as heavily as we are focusing on actually calculating the number.
Great. Yeah, we are getting a few questions in. I think what you were just describing, Supriya, as well would apply to the C-suite and the board as you kind of socialize this internally. So thanks for that description. Another question we're getting, Alicia, maybe over to you is when we think again around the challenge of data and maybe the lack of availability of high quality data. When you don't have information, how do you go about estimating emissions for clients?
Yeah, this has been a huge struggle in terms of data availability. And so we've gone through the various iterations. So thankfully, PCAF does provide a data quality hierarchy and provides guidance on how to estimate the emissions, what should you not have reported emissions from a client. There's a variety of data points that you can use, but PCAF also supplies a emissions factor database. So whether you can source revenue data, you can use revenue data, find a specific emissions factor to estimate a client's emissions. Production data is also a great proxy for emissions. Though if you cannot source any of these data points, there is the lowest data quality scoring estimation, which is the assets estimation. And this is an emissions factor that you just multiply by exposure. So because it's based on sectoral asset turnover rates and then the emissions of a sector, these do tend to be very rudimentary estimations. And I think, as we've gone through the process of calculating the financed emissions and seeing, where we're seeing these potential high attributed clients based on these estimations at the asset level, we've really focus there to try to refine the data as much as possible, because we have seen great fluctuations in terms of what approximation you're able to use. And so as soon as you get some sort of data point such as revenue or production, you see that emissions estimation is greatly refined, and then you get a much better understanding of your financed emissions for that particular client. But as you can imagine, that's a pretty intensive process to do for your entire loan book. So we've had to find ways to prioritize that and engage internally to understand what the best use of everyone's time is when it comes to really refining these financed emissions figures. But we do hope that, with greater disclosure, as years go on, these figures will be better and more easily made accurate.
Great. Well, thanks for that. And I think we'll get into a little bit more of that in the next session, where we go into more detail on the methodologies. But thanks for sharing that description from Citi. Another question we're seeing a comment in the chat is, again, going back to this idea of how do you really socialize and bring on board both the C-suite and the board around this. I wonder if either of you have additional examples, maybe particularly with the board, where you've started to engage with the board on financed emissions. Any experiences there?
So we've had a few sessions. I suppose, as I mentioned, for us, the financed emissions piece is linked to our strategy. And that's something that's quite key in terms of, we have made commitments that go out to 2030, but we need to start drawing out plans now to get to those commitments and understand the starting point. So the focus in terms of those education sessions, and I think we do need to acknowledge that, while they are sitting on the board, this is a new concept, right? So we have started from scratch in some instances where, it's just going through the basics of, this is why this is required. It's the loan and investment book that's in scope. This is how the calculation will work. And starting off with giving some examples. There has been nervousness because, when you look at the data quality score, especially like when we were going through governance through our climate report last year, we are publishing data quality scores that aren't really good because we are making a lot of estimations, but then explaining to people why this is okay, because this is a developing field. And the options are not to do this and wait till data gets perfect, or to publish what we have, but be really transparent. And I think that's a bridge that certain people will find quite difficult to cross, especially those in the board and in the C-suite, etc., because they obviously have direct responsibility. But I think this is where some peer analysis is really useful as well, because most of our peers have now started to adopt this kind of the financed emission calculation process and publish this as well. So I think we as an industry need to push each other along and hold ourselves responsible. And I think using the peer examples, kind of using the industry examples, is a really powerful tool in those education sessions as well.
Great, and I think we're wrapping up to the close of this session. What you just described, Supriya, was a great top tip for people to think about this. Alicia, anything from you as a top tip for companies as they start thinking about this?
Yeah, I mean, I was thinking through, my first top tip is no amount of time is too much time to get started on this process. I think we, have just found there's been so many iterations and understandings that we gain throughout the process that, starting early is really important. And just, I think, using the data's availability and mapping out the data points as guidance is a great way to frame it, but there's many ways, so.
Great. So then starting early with guidance is the next session. So let me turn it over to Blair to talk a little bit about where is the guidance and what are the methodologies being used. Blair, over to you.
Thank you, Brad. Thank you, Alicia. Thank you, Supriya. It was a great panel, and I am happy to introduce our other two panelists, Jackie Lyons from JP Morgan and Ivan Frishberg from Amalgamated. So hopefully get into some of these issues in a little bit more depth with them, and also focus a little bit on the methodological considerations that many of your banks or institutions might be facing or have to make in the next few months. So Ivan, Amalgamated's been involved with PCAF as with Citi and NatWest since almost the very beginning. And so I wonder, maybe start with you, just give us 5 minutes on, you know, the key methodological choices kind of inherent in PCAF, you know, why some of those were made to the extent that you know, and how Amalgamated has had to make decisions in terms of implementing that methodology within your bank.
Yeah, thanks, Brad. Sorry, Blair. Great to be here. And I was fascinated by the last conversation and panel. I feel like Supriya and Alicia did an incredible job. Just to start where you're beginning the conversation. So carbon accounting for corporates has been around for a long time, right? Thinking about absolute emissions in that context. And so the application to the financed emissions sector has been in development for a number of years, but it's really now hit sort of a cornerstone part of the work that banks and asset managers are doing. We got involved with this early on because we had a kind of a long-term strategy around targeting our emissions, and I'll speak a little bit to that in a minute. But we knew that it needed to be measured first, right? We had to establish a baseline. We felt that had to be absolute emissions, which can then be extrapolated into emissions intensity. We needed to really count the unit that people cared about, which is absolute emissions. And we also wanted something that was going to be valid and relevant to external stakeholders, and was going to also plug into what our clients are doing. So our clients are measuring or being held accountable to absolute emissions. And so if you think about it, it's like a currency that runs through the financial supply chain. And so a big part of PCAF was its development, sort of using the greenhouse gas protocol and really just extending it out to the different asset classes, using that same standard. It has the greenhouse gas protocol seal of approval, but making it applicable to the financed emissions case. And so there's sort of two key attributes to that. There's how do you do attribution? So you don't want to take responsibility for a client's full emissions if you're only funding 10% of their what they're doing. And the other is this data quality score. So we're kind of the hierarchy that Supriya was mentioning. And so those are some of the key pieces. It covers most of the asset classes that are out there. We have new work underway on capital markets transactions in facilitated emissions, as also work that's underway with the insurance sector on insured emissions. So all of that is sort of work in progress through this. And as you mentioned very briefly, we've used it in our target setting work. It was the baseline, was our 2020 data. And so we've set an absolute emissions target, 49% reductions in 2030, to get to zero in 2045. And no offsets, heavily influenced by policy modeling built on top of the IEA models for North America. So.
Great, thanks. That's super helpful. And Ivan, I want to come back to what you just said, and it was great to see Amalgamated announce its targets earlier this week. And would love to hear, you guys have been doing PCAF for a little bit, and so how did that help inform your target setting? How did you kind of take the emissions accounting piece of it and then turn it into targets, and then ultimately, I presume, into kind of decision criteria for lending and other services you're providing?
Yeah. First off, I'd say that the target setting work was quite informed by the development of the PCAF methodology and our engagement in that over the last few years. So I think because this is one of the other, I think, advantages of PCAF and sort of working collectively amongst institutions on the standard and understanding how it works. I think really helped us just then once we got to the target setting phase. So I think we had full organizational buy-in because we had spent a few years going through that process and had really learned from other peers. So we weren't kind of doing this on our own or kind of having to face all those decisions on our own. So once we get to the target setting phase, we really have just used our 2020 emissions data by different sectors. We have then applied that using that IEA model, and we really just start with a very standard model from IEA for kind of what the projection is. We kind of factor in growth of those different sectors into that. And then we started to have, I think, some more fun with it. So that was where we started to then look at what could we do with clients. We kind of working business unit by business unit to look at those targets and think about what was applicable to their context and their relationship with clients, better data that they could get from clients, solutions that they could offer to clients. We also looked at this policy impact piece. So we modeled our portfolio, particularly on the real estate side, 2 different jurisdictions, because we know a lot of our emissions come from a commercial building, use of from what their scope 1 and scope 2 emissions are. And so that's often outside of our control. But if you're in New York City or if you're in California or Washington, D.C., you have more ambitious targets for decarbonizing the grid and the building sector. And that allowed us to get to much earlier emissions reductions than we would have otherwise under the IEA model. So, but it really, just having that PCAP data, then having a sort of starting point target, then helped to drive a lot of conversations internally. And the one thing I would say, this is a little bit of a reflection of the last panel and this one, throughout this process, we've engaged with our board, and it's been kind of great to see the evolution of that conversation. And I think there's part of it is, as Supriya was saying, if you start with a strategy conversation with the board, and that these things like carbon accounting and target setting are all how to enable strategy, then I think it's a much healthier conversation. I also think that our boards collectively, I certainly know this is true with ours, is becoming more focused on climate. And I think you can't help it, right? If you're living in the New York area and you've just been through three sort of epic storms in the last few months, people are starting to see that in their kind of loan books, and they're starting to see it in their personal lives, and it's they're working with information not just that they get from us, but that they're getting from their own lives and from the other readings that they do. So that's a very healthy conversation.
Yeah, absolutely. Quick follow-up. I know Alicia on the last panel mentioned that although they're using PCAF, they are thinking about a few methodological decisions for their target setting. So including like this committed credit versus kind of drawn amount that she mentioned. Did Amalgamated kind of have any issues like that, are you using your exact same financed emissions baseline for your target setting, or did you make any adjustments just to reflect how you do business?
No, we didn't. We used our sort of drawn amounts, not committed. And I think that helps us do a sort of apples to apples, because that's going to be then the information that we use for sort of subsequent PCAF reports. And it's an important piece here because PCAP is now embedded into the guidance from TCFD. It's not named, but absolute emissions reporting is part of the Net Zero Banking Alliance, not from a target setting perspective. It's one of the options for target setting, but from an annual reporting perspective. And so we really wanted to have that kind of apples to apples that we could come back to. An important piece of the target setting thing is we're going to have to change and update these targets regularly. I think the models are going to change. We've already, in the process where we're going through our targets, we announced the acquisition of another bank. Over the course of next year, we'll have to integrate those balance sheets. We'll have to then look the following year at resetting our targets. I'm sure the models are going to be adjusted by then. So we know this is going to be iterative. There's never going to be a perfect apples to apples, but we wanted to try to get as close to it as possible.
A couple audience questions that follow up on a couple things you just said. One of them, it has two parts. The first part is a little bit about the methodological choice of focusing on Paris alignment versus net zero. Could you talk briefly to why you made that choice?
The guidelines for target setting within the Net Zero Banking Alliance actually came from the UN collective commitment on climate action. And so that was, I guess, 2019, a bunch of banks committed to Paris alignment as a part of the principles for responsible banking, and then started developing these climate setting criteria under this Paris aligned framework. Now, that is technically a well below 2 temperature objective. But we knew starting about a year ago that we had to move to net zero. And so the guidelines that were developed were kind of ecumenical on what the target was, but really just spoke to the approach for target setting. And so if you're a bank that's well below zero or Paris aligned, you're thinking about zero at like 2065. If you're thinking about a temperature outcome of 1.5, that's where you get to zero in 2050. And so that 15 years is really the difference.
Yep. Definitely heard that loud and clear. One more audience question about external validation. So Ivan, maybe I start with you on this one. Does Amalgamated see a role for external validation of your PCAF disclosures, either now or in the future?
Yeah, absolutely. And it's why I think we committed early to Science-Based Targets Initiative, that we wanted to work through PCAF, and why we were part of the founding of NZBA. I feel like it's easier if you do this together and we're, as an industry, playing by the same rules. The reality, though, in the long term is this is going to be regulated. Assurance is going to be required. That is sort of built into a lot of these things, and will be the expectation from the investor side. And so that in itself is a journey, but that's where we're headed. And I think, for a lot of institutions, they sort of looked at this and said, okay, we need to lean into that assumption and to start to that journey earlier, so that we're better prepared for when that becomes a regulatory requirement. I think there's, we've all seen all the press around and the commentary around NZBA, and is it real or is it not? And I think that's we have a lot of stakeholders to satisfy in this: regulators, activists, clients, investors. And so I think there are going to be a lot of credibility questions that we all have to wrestle with along the way. I think the first one that we know within NCBA is and actually in the asset side too, is the continued expansion of fossil fuel reserves, which we know are inconsistent with the 1.5 degree scenario. And so how are we going to wrestle with these things? What are the kind of outside validation that we can point to with respect to our work being rooted in science? And that's a really important piece of sort of allowing all of these frameworks to move forward with confidence and collaboration.
And thank you to our previous panelists as well. That's all the time we have, but Brad, I think, is going to close us out. So back to Brad for just a minute.
Thank you.
Yeah, thanks so much, Blair. And I think hopefully as those attending have learned, this is a journey, but the first part of that journey is getting started and figuring out how to work across the organization, including the finance team, is the key to do that. The good news is there's practical guidance to help. So Stephen mentioned earlier some of the recent publications from Ceres. A4S has published a few case studies. We also have a guide for finance teams of banks on achieving net zero. Those publications will be included in a follow-up email to today's session. So again, thank you for all the panelists for joining today. Thanks for Ceres for hosting, and thank you for attending, and have a great rest of the day. Take care.